Assalamu alaikum everyone, welcome back to another video. I hope you're having a great day. Some of the highest quality companies in the world are finally trading at rare discounts, and if you are a long-term investor like myself, December might be one of the best buying opportunities for all of us. Today I'm going to cover 7 high quality stocks that are on sale right now. So we have been, in terms of the overall market and where it is right now, it's hitting that all-time highs again. And this, although November has not been great for the stock market, but it hasn't actually been that bad, because when you look at the year to date, for example, we're still up 16% in the S&P 500. Dow Jones is for 12%, 21% for the Nasdaq, and 17, almost 18% FTSE 100. So the FTSE 100 is beating the S&P 500 for the first time in a very long time, which is quite interesting itself. And if you look at the fear and greed index, as you can see here, we are in extreme fear still. So what I'm going to do now is I'm going to cover 7 companies that are still undervalued at this point in time. As always, please do your research, find out more information about each one of these companies, because of course, as always, I'm not a financial advisor, but you need to make sure you're doing your own research. If you haven't joined us at the Patreon account, please do so. It genuinely helps the channel. If you haven't liked the video already, please do so. It genuinely makes a huge difference. So let's get started. Let's look at these 7 companies that that you came here for today. And the first one is ADP. ADP is one of the most reliable dividend growth companies in the world. Right now, the stock is trading rare discounts and 19% below the intrinsic value, according to Morningstar valuation. So they think the price should be about $305 per share. Right now, it's $255 per share. It has a dividend yield of 2.6%, the payout ratio of 61%. The last 5 years, they grew that dividend over 11%. The dividend streak is 51 years in a row. That means they are a dividend king. Kings are companies that have increased that dividend over 50 plus years. Dividend aristocrats, 25 years or more. Annually, you get $6.80 for every share of this company that you own. Profit margin is about 20%. Return on equity is 70%. You will not find companies like that in this, to be honest, in the S&P 500. Return on invested capital right now, as it stands, about 38%, almost 39%. Free cash flow of almost $5 billion. They're expecting the earnings to grow about 9%, revenue about 6%, and like I said, 19% right now below where it should be trading right now. And if we look at a couple of things about this company, so if we look at the annually, for the last, say, since 1986, you can see the revenue has been growing year after year. Last 5 years, that revenue grew about 7%. Last 10 years, about 7%, almost. Now, net income is heading the right direction. The EBITDA is also heading the right direction. Free cash flow, which is very important. This is the money the company uses to pay the dividends, to buy back their own shares, to pay off any dividend, any debt that the company has, acquire other businesses, and so on. EPS has been growing every single year. That genuinely looks so beautiful. Now, dividends, exactly the same. It's been growing over the last whatever years. Last 5 years, they grew that dividend almost 13%, which is really nice to see. And as you can see here, okay, shares outstanding is declining. So they're buying back their own shares every single year, which is nice to see. That means every share of this company that you own is now worth more. So really great company overall. And if you look at the return of capital for this company for the last 5 years, is about 8-something%, which is really nice to see. So that's the first company, and it's still undervalued at this point in time. Please like the video if you haven't already. Linde is another one. This is one of the industrial companies, not industrial, material companies that I used to own in this portfolio quite some time ago. It has a 1.4% dividend yield, 36% payout ratio, 5 years is 9%, and dividend streak of 32 years. So that another dividend aristocrat. Annually, you get $6 of every share of this company that you own. Profitability side of things and management effectiveness is actually quite good. Almost $5 billion as well in terms of free cash flow. EPS is expected to grow about 9%. Revenue is expected to grow about 5%. And Morningstar is saying right now 15% upside from where we are. Just to learn a little bit more about the company, revenue side of things is heading the right direction. It's been growing over the last whatever years. The EBITDA is exactly the same. Net income, exactly the same again. Free cash flow, it has declined a little bit, but it's not from $5.6 billion to right now about $5 billion. So nothing huge to worry about there. In terms of EPS, it's heading the right direction. Dividends has been growing every single year for the last whatever years. The return to shareholders side of things, as you can see, about last 5 years almost to 10%. And if you look at the shares outstanding, they've diluted it a little bit in 2018. Since then, they have been buying back their own shares, and I think that's when they acquired another business, I think, at the time. So from that side of things, the company is doing really well. So let's now look at the valuation for ADP, because I want to make sure that we understand. So this is ADP, the first one that we looked at. If we use the normal multiple, which I'm going to focus on for now, if you bought this stock right now, you would be making about closer to $5,260 per share, basically on the top of the $10,000 you've invested by 2028. Now, if we look at this one here, again focusing on the normal multiple for this company over the last whatever years, which is that 29 PE, the multiples. Okay, you can see here about if you invested 10,000 today, you will be making about 14,000. On top of your money, you'll be about $4,366 per share. So another one that seems basically right now undervalued, according to also FastGraph. Now, if you basically, the next one is S&P Global. This is the one I've been talking about quite some time. Another dividend king, decent dividend if you like, in terms of profitability and the the margins. With regards to return on invested capital and also return on equity, the company is doing an absolutely amazing job. Free cash flow right now $5.5 billion. EPS growth basically expected to grow by 11%, revenue about 7%, 14% upside from where we are right now. Again, another one that has done absolutely amazing job over the last whatever years. As you can see, the revenue is growing every single year beautifully. Last 5 years about 16%, last 10 years about 11%. EBITDA is heading the right direction. Net income, free cash flow, growing about almost 16% in the last 5 years. EPS exactly the same, heading the right direction. Last 2 years about 10% growth side of things. And if you look at the dividend side of things, they have been growing that dividend every single year for the last 50 plus years. And if you look at the shares outstanding, has declined quite a bit, and then they've acquired another business about a couple of years ago, and then of course they diluted the shares, but now they're buying back their own shares, which is quite nice. And if you look at the basically last 5 years, return to shareholders is about 19%, which is quite nice. That return of capital is absolutely amazing. Now looking at FastGraph, again, normal multiples for this company. If you bought this stock right now and you invested 10,000, your 10,000 will become about 14,000 by the time we get to December 2027. The next company that we're looking at today is Clorox. This is probably the wild card here because it's a company that is down a lot, 54% upside from where we are. But the growth side of things is basically there is a story behind it. They are now sort of stopped basically investing in specific products that they had. And because of that, the EPS and revenue, of course, will be affected because they're no longer basically selling that product. So, and they're not sort of replacing that. So they're focusing on their most popular product. So they're going through a transition right now. That's why the EPS is actually down on revenue, is quite down, based down a lot. But in terms of dividend side of things, it's absolutely amazing. The only issue I would have with this one is the payout ratio. It is quite high. But again, if the company still have a good free cash flow based on that $13 billion that they have, and at right now 54% basically upside from where we are, which is quite interesting. This is the one I'm actually seriously looking into, inshallah, in more details in the coming weeks, inshallah. Because one of the things I liked about it is the fact that the company, in terms of product that they sell, is very well-known products. It's consumer staples, and it's one of those companies, if we see the market going down quite a bit and so on, it is one of those low beta companies that will pay you, look at that dividend, basically that guaranteed almost a 5%, which basically moving forward is very attractive to me anyway. I don't know about you guys, but I do like that. Now looking at in terms of revenue side of things, okay, it's been heading in the right direction, a slight decline, and now sort of a bouncing back next year, which is quite interesting. And EBITDA again is bouncing back. Net income exactly the same. Free cash flow more or less the same. EBITDA again same thing, from $2 to $6.5 in basically next year. Dividends been growing quite nicely. They've been buying back their own shares. And then if we look at this here, return of capital. This is the type of business that you expected, that 3-4% every single year, plus that including that dividends that you're going to receive from the company. So it is really a one of those predictable companies. And right now, according to this, is also if you bought this stock right now, by the time we get to June 30th of June 2028, you would be almost doubling your money. If basically we are looking at that 27p, maybe that 27p is not realistic, and you can still buy this stock even if it's 18 PE. Right now it's about 15, I think. Even if you go to that low, you still be making about 18% if you like. So it's an interesting one that I will potentially be looking at, inshallah, in the next few weeks. I'll let you know how it goes. The next one is EOG Resources. Currently it has a 58 billion market cap, over 3% when it comes to that dividend yield. The payout ratio is very low. They have been increasing that dividend for the last 8 years. Now, in terms of profitability, is decent. Free cash flow is good. They're expecting the earnings to grow about 6%, revenue about 3%, 29% upside from where we are, which is very interesting. It's a company that I own in my portfolio, so it will be interesting to see how things go from here. But revenue heading the right direction. 2020, remember, these are very cyclical businesses. Oil companies, they trade it with sort of a commodity, if you like. When oil prices are doing really well, the companies tend to do well. The net income is good. The free cash flow is actually quite nice. The EBITDA, the EPS, for example, earnings per share, has declined. So in 2024, let's see what happens in 2025 once they report that. Again, the dividend has been growing over the last whatever years. Shares outstanding is slightly declining. And if you look at, for example, things like the return of capital for this company last 5 years, 54%. You will not find many companies that are giving that sort of margins. And normal multiples for this one, if we look at the expectations moving forward, if you invested 10,000 today, you'll be making 14,400 by the time we get to 2027. By the way, if you haven't pressed that like button, please do so. It really genuinely helps the channel. The next one that we're looking at today is FactSet Research. This is basically data sort of a company. A lot of websites that we normally tend to basically use actually use this company to extract so far all the financial details that we normally look at. It's quite small, only $10 billion. Excellent free cash flow, 25 years of increasing it. So the dividend aristocrat. They are actually the S&P 500, so that means they become a dividend aristocrat this year. Return on profit margin, return on equity, return on invested capital is really good. Of course, for a company that's only $10 billion, that's not bad. Just less than $1 billion of free cash flow. They expected the earnings to grow about 2%, revenue about 5%, almost 40% upside from where we are. And looking at the revenue side of things, look at how beautiful that looks. That's ridiculously beautiful. Look at that. The same thing again, growing at basically 12% over the last 5 years in terms of EBITDA, in terms of net income about 10%, which is really nice to see. Free cash flow growing about 7-8% almost over the last 5 years. Dividend side of things in terms of 5% in the last 2 years, 7-8% almost in the last 5 years. Shares outstanding are declining, which is nice to see. And then return of capital to shareholders, if you like, is about 8% in the last 5 years, 3% in the last 10 years, which is nice to see. And if we go in here and have a look at the company in here, you will see that 30p, even if we say is not going to be 30, it'll probably be, let's say 18, for example, right now. You will still be making up over about 38% total rate of return, basically, if you like. But if we use that 30p, you will be doubling your money plus more, which is quite interesting. And the final company we're going to talk about today is Copart. This one is being left for dead for quite some time now. 37.7 billion market cap, has a wide moat. It doesn't pay any dividends at all. Very, very profitable business. $1.5 billion of free cash flow. Expected the earnings to grow about 4%, revenue about 4%, 33% upside from where we are. I know a lot of the community, basically the brothers in the community, you basically own this company, and I see weekly buys from them. By the way, if you haven't joined on the Discord, there is a link on the description. Join that for free. And basically there's a lot of wonderful brothers, mashallah, tabarakallah. May Allah actually bless them and bless their investment and everything else they're doing, because they're genuinely sharing good practices, more than I could share. Alhamdulillah, that's why I made it free, so you can also join it. And yeah, when you get a chance, please join that and just support the brothers out there as well. Now again, looking at things like the revenue side of things, look at how amazing that looks. 16% in the last 5 years. EBITDA looking about 18%. Net income 17%. This is very high quality business, I'll be honest with you. Look at the free cash flow, 31% over the last 5 years. Last 5 years, when it comes to EPS, 16-17% growth, which is ridiculously amazing. So really great company. In terms of shares outstanding, for the last 10 years, they've actually bought back 0.7% of their shares, which is quite good. Okay, as long as they're buying back, that's really good. Of course, the company doesn't pay any dividends, but as you can see here, basically a lot of that comes from, there's no actually dividends, so a lot of that comes from basically the buying back their own shares and so on. Now looking at how expensive or cheap this company is, using that normal multiple of 34, as you can see, if you bought the stock right now, by the time we get to 2028, you would have 16,468 if this basically works out. Again, currently is about 24 blended PE, so if you use that, basically you'll be making about 15% total rate of return, which is quite good as well. So that's the 7 companies I want to share with you guys. This is not high, basically this is high quality companies, but they're not really AI companies. And so this is a sleep well at night sort of a businesses that have been around for quite some time, will be around for a very long time. They have sort of a predictable sort of a businesses. And yeah, that's what I want to share with you guys. That's the Shariah-compliant side of things. You can have a look at that, pause the video. No concerns from my side in terms of with regards to that. But yeah, that's the 7 companies I wanted to share with you guys. If you enjoy this type of content, it takes a lot of time and effort to put this together. If you can join us at the Patreon account, you're actually supporting the channel. Like I said, join the Discord, and yeah, I'm gonna do portfolio update inshallah. Next couple of days, we're hitting all-time highs right now, and I don't know how long that's going to continue, but I'm going to keep doing what I have been doing over the last whatever years, and just adding to the companies that I own and looking for high quality businesses to add to the portfolio. Inshallah, I'll do a a whole portfolio update inshallah next couple of days. Have a wonderful day. Assalamu alaikum.